There are a whole host of things to weigh up when investing in property. Where and what to invest in, your budget, and who to trust being prime examples. As we discussed on a recent podcast, market timing and the use of off-plan property to mitigate the high cost of borrowing at the moment being another. Basically, the more research and advice you can give yourself access to, the better the outcome will be. Buying property for investment is all about making well-informed choices. Welcome to our latest episode of the Harbour Property Group podcast. I'm Chris Thompson, and today we'll be delving into some of the things you should be thinking about before getting started with or further building your property portfolio. I'm joined today by Sion Bennett from Centrick, and together we'll explore the 5 key considerations to making a successful property investment decision. Hello, Sion. Great to have you on with us for this episode. Would you like to start by telling us a little about yourself and what it is that Centrick offers the property investor?
Sure, cool. Thank you, Chris. So my name's Sion Bennett. I'm from South West Wales, similar to yourself. I've been living in Hong Kong now for about 4.5-5 years. So I'm a director at Centrick. So basically, Centrick they've got a large office in the UK, actually in the Midlands. They've got around 250 staff in the Midlands. So they predominantly or historically have been in the kind of build to rent and building and estate management area, I suppose. They've got around 25,000 properties under block management and around 500 blocks. So what that means is, when, especially with the build to rent as well, but when landlords pay their service charge towards a company, they look after that whole block, the common areas, doing the bins, all that kind of stuff. So very kind of very market proof in the sense that, it doesn't matter what happens to the market, it will always be needed. They did have a lettings arm, but just recently sold that to focus on the kind of Centric Invest side, which is where I am, as well as they're building a £1 billion academy to train up some younger kind of staff and help the property market. As I said, I'm a director at Centric Invest. I'm based in Asia, and effectively I help expats access the UK property market. We help, along with kind of companies like yourself, we help with the cliche term as an end-to-end service or one-stop shop or turnkey service, however you want to word it. But we have the developments, we're master agents for developments around the UK. So we're not actually necessarily building them, but we control the sales of that development. And then again, we work with yourselves and we help with solicitors, mortgages, renting the property, the whole kind of 9 yards effectively to make it as hands-off as possible. Because as you know, and as I know as well, expats tend to have the money, but not the time, right? So that's where we come in.
Yep. Brilliant. Thank you very much. So what are these 5 key considerations then? There are many more, of course, and a more detailed exploration of your property goals will, I'm sure, unlock others. But the 5 most important in my mind is location, rental yields and capital growth, property type, size and value, off-plan or completed property, and then financing your purchase. So let's look at location first of all. Finding the right place to invest is equally as important as the right property type. Billions of pounds are being spent across the UK in developing towns and cities, not to mention road and rail infrastructures and community spaces. There's a great deal to choose from. What are your thoughts, John, on what investors should be considering when thinking about location?
Sure. So look, this is the biggest one for me. I mean, it could be said that anywhere across the UK long term is going to go up in value. There's such an undersupply. It's a chronic undersupply. It has been for the last 40 years, but it's only really gone worse, especially the last couple of years with construction, things like that, and build costs. There's such an undersupply of properties. You could argue that anywhere across the UK, again, on that medium to long term, which we are buying property for, is going to go up, right? So the biggest thing I look at, you mentioned infrastructure there, and that is the biggest thing: infrastructure investment, government fiscal policy. So where the government is spending money. There is, I'm sure a lot of the people listening have heard of the Levelling Up Fund, which is a government-run fund, and it's effectively trying to spread some of the economy away from London to these regional areas. Of course, a lot of people heard of the Northern Powerhouse, for example. Manchester being the face of that Northern Powerhouse. They'll do things like tax incentives, infrastructure, railroads, trains, roads themselves. Help companies with offices. I just read the other day in Birmingham, there's the Levelling Up Fund is helping Birmingham City football team build a new stadium, things like that. Again, so In my mind, if there's government infrastructure investment or private infrastructure investment as well going into that area, that usually means there will be economic migration, meaning companies moving there, also people moving there. That then means high skilled jobs, salary increases, which again is all good signs of property price increases, as well as feeding into that supply and demand. Again, we do have properties in London. I would say 99% of our clients are buying in regional cities. When you look at, again, the forecasts are forecasts for a reason, right? Where you never truly know, but consistently over the last few years, and especially even more so recently, when you look at the likes of Knight Frank, JLL, etc., when you look at their forecasts over the next 5 years, they all expect these regional cities such as Birmingham, such as Manchester, such as Nottingham to outperform the capital city.
Yep. Excellent. Thank you very much. So, okay, consideration number 2, rental yields and capital growth. So I think it's fair to say our clients' needs are all very different. Some clients are looking for yield-rich investments, others the long-term underlying growth opportunities. Many are looking for that sweet spot with generous yields and steady growth. So, Sean, what should clients be looking out for or considering when it comes to getting this balance right?
Yeah, sure. I think, okay, you touched on it yourself there. It's a very individual thing. Of course, it depends what your situation is, what your job situation is, what your age is, what you want out of this property. I think the stereotypical client, again, is buying this for the medium to long term. Yeah, there are some areas, especially in the north and things, you can get some very cheap properties and with high yields, and because of the kind of rent to price ratio, which is great. But again, is there much kind of growth? Is there much investment going into those areas? There tends not to be on the whole. Okay, so you have a high yield, but your chance of capital appreciation of price growth is not that high. If you look at London, for example, as I said just now, the expected price growth isn't too high, and the yields of the rents have been flying the last kind of 12 months in London as people have come back to the city. The yields still, again, aren't as high as some of these regional areas. In my opinion, I think a nice kind of sweet spot is these regional areas, again, as I mentioned, where you're getting a nice strong yields between 5 and 6%. The average yield in the UK is on 4.5%. Okay, so you get a nice strong gross yield, 5-6%, but also getting that capital appreciation, because that's where the real money is made, in my opinion, on the capital appreciation. If you're making 4-5% growth per year on the property price, in 5 years, you've already made your 25% deposit back. And that's without the compound growth and also without the rental yields. So again, I think that nice kind of sweet spot where you've got a nice strong yield, it's going to cover your mortgage and all that, but you also have a really good, strong chance of capital appreciation.
Excellent. Thank you very much. So might be a little bit of overlap here, but a key consideration nonetheless, but property type, size and value. So similarly to the last question, talk us through what investors should be considering when looking at this particular part of their buying criteria.
Yeah, sure. So this is something I want to mention. This is something Centrick are taking very seriously. We've just actually put together a 50-plus page document called Love Where You Live, where they've gone and interviewed hundreds of people around the UK and see basically what they like. And we're trying to be kind of market leaders in that research-led investment. So, trying to be the research being at the forefront of our investment, I suppose. So they asked different what people like. Could be car parks, could be outdoor space, could be amenities like gym, things like that. And of course, different areas did have different considerations, but a lot of them said that kind of outdoor space, whether it was in the property or nearby. A lot of them said also having amenities, again, like gyms and things nearby, and a lot said car parks. Okay, so they were the three main things that came up. Now, the biggest thing I often get asked is apartments or houses. I've got a house in the UK from when I lived in Cardiff, and it's great. But again, as an overseas expat, there's things that, for example, the garden, I have to get it sorted out, or perhaps damp, or different kind of things like that. And it is a little bit of a headache. For that reason, I personally, especially for expats, I prefer apartments. They come up with the latest regulations. They've got the highest kind of EPC, energy performance ratings as well. And the other thing, they have 10-year build warranties, things like that. The other thing to note is they tend to be in city centres, right? In and around city centres. And that's what a lot of young people and young professionals want to live, and that's where they want to live, and that's where they will live, right? So again, to double down, I suppose, or to double down, for me as an overseas investor, apartments are where it's at. If you're in the UK, perhaps houses, doing up houses is a nice idea, but just for peace of mind, you don't want to be taking on someone else's issues, someone else's problems. I think the apartments are where it's at.
Yeah, absolutely. When you start pulling things apart, taking walls down and so on, it can uncover all sorts of issues, can't it?
Exactly. Yeah.
I mean,
we do have some actually properties which are completed and they've got tenants in place and stuff as well, and that they're great and they've been really popular, but they do have, they've got the additional kind of building safety regulations, the EWS1 checks and things like that, which again are fine, and they all pass it. But for example, we had one where completed and then there was a bit of damp in the roof, or there was some paint coming off the wall. Which again, obviously, when you're buying these investments and you're upfront about it and say, look, this is what you're buying, right? But again, as someone that's overseas, you don't really want those headaches, right? You don't want to be getting woken up in the middle of the night with these kind of silly things, I suppose. So yeah.
Yeah. Okay. And I suppose the final point on, houses versus apartments is you can't get in line, you can't get in the queue with an existing property, a house. With some developments that will offer houses, but few and far between. So typically new builds or off-plan property will be apartments. Any desirable properties that come up on the market, houses that come up on the market, tend to get snapped up pretty quickly or will have problems within them. So being able to get in line, being able to sort of reserve a property that's, so I don't know, 6 months down the way, or even a couple of months down the way, or even brand new, can be very useful.
Yeah, for sure.
Okay, we covered some of this topic in a recent podcast, but it definitely sits comfortably in the top 5 key considerations. So number 4, do I invest in off-plan or completed properties? So the topic, I think, reaches a little further now than just the cost of borrowing and interest rates, which obviously is off-plan properties have been quite useful for pushing those higher rates further down the road. But what do you think investors should be considering in the round when it comes to the two, off-plan or completed?
Yeah, again, it again comes down to the individual a lot, I suppose, how much money they have and things like that. For me, I've had a lot of investors recently who have enough money to do something completed, but they've actually elected to do something off plan, or they've started with something completed and then ended up doing something off plan. Why is that? One is what you just touched on about off plan. That's kind of widely accepted or expected, more so, that interest rates will drop, maybe a bit more of a softer drop than we were expecting, not quite as quickly, but in 12 to 18 months, everyone's expecting them to be lower. So of course you can get into the property market now and expect to have a better interest rate in 12, 18 months, whatever that is. The other aspect is the mortgage market is just very, I suppose, fluid is the word. There was a BBC article that came out a few weeks ago about mortgage offers getting pulled within 9 days and things like that. Banks are changing their rates. They're changing, changing the goalposts a little bit. And it just becomes very frustrating. And that's where it comes in what I mentioned about I've had a few clients who've started on something completed and then they've just kind of got a little bit fed up of sorting out the legal side and then also sorting out the mortgage paperwork at the same time. It's just quite a bit of an overload. So they've just got a bit fed up and they've just switched to something off plan where you can worry about the legal side first. And it's very important, to make sure when you're doing something off plan, they have things like, they've got full funding in place. So it's not using the client's money towards the build of the property. They have deposit protections in place, things like that, of course. But you can just worry about that legal side first, or you can worry about the mortgage side a little bit later. So again, I'd say probably 95% of our clients are going off plan. Of course, there's time for completed stuff, and sometimes you can get a good deal. But going back to what you said as well, a lot of these things about getting in line and stuff, if you want to get in there early, I think the off-plan market is also the way to go.
Yeah, you can make a little bit of money on the way in, can't you? You need to be careful, obviously, what expectations we set for that. But it is, it's the reality is that if you buy off plan, the earlier you get into an off-plan development, if you're 12, 18, 24 months even out, if you get in nice and early, then you're likely to see price rises during the build phase that, so effectively when the day you get the keys, you may have already made money on that property, which is quite a nice place to be.
Yeah. I mean, from the clients that you're helping at the moment, Chris, what percentage would you say are ending up, or maybe starting when they come to you, are they wanting off plan, or how many of them are ending up buying off plan? What are you kind of seeing in your market?
Yeah, so similar statistics to those that you mentioned. So say about 95% of clients are buying new build, and much more than half of those are off plan. It can be very appealing for quite a lot of reasons. Making money on the way in, shiny new thing, being able to the accessibility to that stock. Finding new and exciting areas. I mean, Derby, we've talked a bit about, haven't we, recently? It's all just starting to happen, and when you get that energy in place and developers are catching up and all the cranes are moving in the sky, that's the time to be getting stuck in. And if you can get in right at the start of that process, right at the start of that development, then you can make quite a bit of money on the way in. So I'd say 95% new build, and a good 2/3 of that will be off plan.
Yeah. Cool.
Okay, so finally, the fifth of our top 5 key considerations, and financing the purchase. I think it'd be fair to say that a good majority of investors will take some form of borrowing when purchasing buy-to-let property, but in varying degrees. So what are the typical considerations, Sean, when for investors when summing up their financing options?
Yeah, sure. So again, this is where our expertise comes in, I suppose, is that I always recommend to work very closely with a mortgage broker, and I speak to the main mortgage broker I use multiple times a week, and work closely with them. Especially with the new build market, it can be a little bit more complicated. How I always describe it is, look, there's a pool of lenders. If you're based overseas, for example, that pool goes a little bit smaller. If you don't have a UK bank account, that pool goes quite a lot smaller. If you don't have a job, pool goes a little bit smaller. I can't say always, but there will always 99.9% of the time be a lender. Of course, the smaller that pool is, the higher interest rate you're going to pay. Right? So again, there's things that when you're buying a property to live in, the bank is more worried about your circumstance. Can you pay the mortgage as well as buy your groceries and do whatever you want to do? When it's a buy-to-let property, of course, there are thresholds that you have to hit. A lot of the time, some of the banks are maybe £25,000 a year earnings. Again, there are banks who will do no job at all, but usually they're around £25,000 a year earnings. But they're more so worried about that property. Is the property going to rent out enough to cover? They do these stress testings to make sure it covers if rates go up. Will the rent cover the mortgage? Is it worth what you're paying for it? Things like that. So a lot more worried about the property. So there are different things to consider. As I said, there's always a lender, but even when there's an off-plan property, we're talking about off-plan stuff. Quite now, I advise clients to chat to a mortgage broker. They can't give you a mortgage there and then. They can't guarantee you a mortgage, but it's quite nice. They'll look at your situation. They'll look at your job situation. What you're up to in the next 12 months, and they can just give you. They'll give you that little bit of confidence to go ahead, because it doesn't help anyone, right? If you get to the end and it's a little bit messy. So again, it's important to work very closely with a mortgage broker, I think is my main point.
Yeah, and there's some great brokers out there, isn't there? So okay, brilliant. Well, thank you, Sean. Massive thank you to you for joining me and sharing your experience with us. As mentioned earlier, these 5 key considerations aren't an exhaustive list, so if you've not already done so, please get in touch with me to book in some time to fully explore your goals. Remember, your property investment decisions ultimately depend on your individual circumstances, but with the insights shared today, hopefully you'll be better equipped to make a more informed choice. For more information, please visit our website at www.harbourproperty.group for further resources and to book a free consultation. And please don't forget to like, subscribe, and share this episode with anyone interested in the UK property market. For now, though, a massive thanks again to you, Sean, and from me, thanks for listening, and bye for now.
Cheers, Chris.